Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at the 3M earnings because they announced this morning and the stock really seemed to like it, or at least the market did, because the stock continued to run and ended up having a pretty good day, up 5.3%. So I'm just taking a quick look at these earnings. I've pulled all the numbers that we need, so there's not a whole lot to see here aside from the big standout is this loss here, the net loss, the total operating expenses of 17,283 when last year for the same quarter it was 8,592. And this is all stemming from lawsuits. So they've settled on one of the lawsuits that they had ongoing, $10.3 billion settlement. And that will get this off their backs. They'll be paying this out over the course of a few years, so it's not just a lump sum start uh, hit to the company. They'll be paying it out over 13 years and could go as high as $12.5 billion a year. But they do have other litigation that is ongoing, like the earplug lawsuit, which is looking to be another $8 to $10 billion lawsuit for the company. So we'll take a look at how this water settlement affects the company and how the earplug settlement would also affect it. So to start, just based on its normal operation, we are looking at this here. We have a nice floor around that $100 level. That's where I have done quite a bit of trading. This stock is currently on the hold list. We looked at it a few months back and really didn't like some things that we saw, but it was already in the fair value range. So didn't look like there was a whole lot of downside to it. And it was down in this range. So it went down to $100 and stayed there for a little bit. And it's on its way back up now after these earnings, because they got one lawsuit taken care of. Now we just need to see what the next one brings. But we see a margin of safety around the $121 mark, a fair value around 142, and an overpriced 157.5. So that's what we were looking at the stock as of the end of last year. And we'll see how all of this gets affected by the current performance of the company. So we have everything here. I've pulled out their year-to-date values and the percent to goal. So this is a little strange with a $10.3 billion hit where it looks like they have a massive negative because they reported negative $12.35 per share. But the adjusted number isn't so bad. The adjusted number, they made somewhere around the realm of $2.14 a share. But we're going to stick with reality and actual accounting principles. So we have revenues above track. So it looks like they can definitely come in above that 28.5 that's expected of them. Maybe somewhere more in the realm of 29, 30, something along those lines would work to improve the situation a little bit. That gives them 5% leeway, going up above 30. That's pretty nice for them. Cost of goods, they're a little above trend here, so they're running on a lower margin than what we would have typically seen for the gross profits. Gross profit, they're slightly above trend or slightly above the goal. Expenses, they, of course, with that $10 billion, are pushing the limit of expenses already at this point. So this is going to be a number that's going to be negatively impacted this year, potentially even next year as well. So they've got a little bit of a rough spot to go through. Net profit is negative because of this earnings. They had a decent quarter, first quarter. Share count, they are buying back shares way faster than expected. which is good. If they believe that the share value is very low, which it clearly is, I don't think many people would deny that. It's currently trading close to a 10 PE, which is a very good deal for a stock such. Shareholders' equity has declined a lot. We were expecting some growth from 14.7 to 16.7, but instead we have a drop down to 7.8. So that is because of the liabilities jumping by about $10 billion and really having a negative impact on everything. That equity, the debt to equity ratio, the book value, and those were already things that we had in question. If you look at this, 48.8 for assets, 41.02 for liability. So they have a negative tangible book value of negative 9.48. We were hoping that this year they'd come in at negative 1.73. Some nice movement from last year's 2.72, but that's clearly not going to happen with the way that things have shifted. And if the other lawsuit gets settled in a similar fashion, then this would double to the negative direction. And it would be quite some time before we saw any hope for the balance sheet on this company. Already, they had a debt to equity ratio of 2.15. We do not touch anything with greater than 1 debt to equity ratio, and this has pushed them to a 5.22. So definitely alarms going off for me there. They do have quite a bit of cash. They have $4.26 billion, up from the 3.66 that they had last quarter, but that's still only $7.69 per share when their total book value per share is negative $17.12. The dividend, they are a pretty good dividend grower. They've gone slow with it. They are now to the point where 1 cent per quarter, so 4-cent growth per year, is what they are paying out and what we'd expect to be moving forward. But it's currently at today's price yielding almost 5.5%. So at some point, the company does need to question if it's worth it to be paying the dividend, or if they don't care so much about the title of the dividend aristocrat and care more about the future of their company, because they can handle the debt a whole lot faster paying it down by cutting that dividend. Now, do I think that they should do that? No, they will definitely be punished by the market. They will 100% fall below $100 if that were to happen, because we see here a lot of the value is coming from that dividend. This is a dividend stock. They're not huge on earnings. They're not huge on growth. Their cash flows are all right, but it's really the dividends, because that balance sheet has never really been pretty. Their ROE artificially looks good due to the heavy debt that they have, because those liabilities are very close to those assets. It wasn't as bad previously, but still, a high debt to equity ratio and a high ROE is a sign that that's just debt diluting the equity, making it so that the revenue returns look higher. Right now, they're sitting at negative 74.6%. So definitely not going to have a very good ROE value this year. So how all this shapes up, this is what we'd be looking at. Margin of safety in the 20s, a fair value in the 40s, and a overvalued just about 160. So we can go and take a look at the trends here. Financials, not a good trend. We see a downtrend. We see mostly flatness. Cost of goods are also mostly flat. And they really don't seem like they're moving quite as much as the bars are in the magnitude of their differences. Gross profit, net profit, and EBIT. What we're looking at here is a peak in 2021 and a decline. That's the same that we see in all of these. The balance sheet has never really been pretty. It's very flat on assets. Liabilities, we see a mostly similar story, a little bit of a decline, and that tangible book value was going to be positive here soon, but not going to be at this point. Free cash flow, we kind of see some inconsistencies, a lot around that $5,000 mark. Hopped above in 2020 and 2021, dropped below in 2022, but otherwise it's been really close. Dividends, like I said, they are a pretty good dividend grower. And the actual graphs of the prices, which I love to take a look at and see what exactly is going on here. That balance sheet has been improving over time, not correlated with the stock price at all. And looks like one of the highest is always the cash flow. So they are very strong on their cash flow, which means they probably have some pretty strong net margins. Net margin, 16.88% in the high 16s. So their margins are very good. Their cash flows are very good. Their balance sheet, they really need to be taking that cash and putting it towards showing up that balance sheet rather than acquisitions, which they do a lot of, that don't seem to be giving them much of an edge, considering that the compound annual growth rate for their revenues are 2%. Their earnings 8%, but as revenues have picked up in the more recent years, there's been a decline in the earnings. So that is something to be aware of. And the orange line here is that fair value. So it's pretty consistently in the middle here. Right now, sitting at that 140, there was towards the beginning of this time frame, up through 2021, the share price was above that fair value and has dipped way below now. So it's not a stock that typically trades at a discount to that fair value. And I definitely believe that there is some upside to it, 40, 50%, but there is also a lot of inherent risk. I mean, those cash flows are going to be impacted by these lawsuits. The earnings, potentially, I mean, if you look at the standard earnings, they're definitely impacted by the lawsuits. And the dividend, they just keep chugging along with. If they were to cut that, there'd be a fast and strong drop in this stock. But that's what we're looking at here. So I feel like it's got to stay on the hold portfolio. There's just too much risk with it. Like, yes, there's some decent upside. Looks like the Peter Lynch formula is saying that this is slightly undervalued, not too terribly much. As for the yields, earning yield, I mean, nothing incredible every single year. It's okay. It's definitely decent. Free cash flow yields are very strong, though. So if they could fix that balance sheet, I would have no problem holding it. But the fact that it's gotten worse and it's looking like it will continue to get worse, they're going to tack on another likely $10 billion in debt. They're going to have a rough time. But we'll keep following it and see how things go. So thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other earnings that you'd like to take a look at, or if you disagreed with any of this. I'd love to know. And subscribe so you can stay up to date with everything. And I'll catch you next time.